This report brought to you by the Richmond Club, where investors and high-growth companies meet.
Good afternoon, ladies and gentlemen. Our first speaker is the President and CEO of Prairie Provident Resources. Please welcome Mr. Tim Granger.
Thank you, everybody, and it's my pleasure to have the opportunity to present to the Richmond Club today. I am with Prairie Provident. We're an E&P company based in Western Canada. So what sets us apart? What's our differentiating factors? We are 70% liquids, 26% of that is light oil. In addition, we have a very low decline rate of around about 18% and diminishing, so that leads to stabilization and free cash flow is what we're really alluding to. In addition, I'm going to show you that we have about 5 years of development in front of ourselves, so we don't have to go out and acquire more land or get more assets, but we have 5 years of development. And this is development that is on the PDP basis, like proved developed producing basis, so it's not probables or farther afield developments. And so we really believe that we're well positioned to participate in the oil and gas recovery when that comes around. In addition, we are strongly hedged, so we believe in hedging our balance sheet to protect ourselves in the down cycle and manage our economics going forward. What's our strategy? Twofold strategy. First off, we will continue to develop our conventional oil and gas assets. We've got 3 plays that I'll discuss, Evie, the Machichi, Wayne, and the Princess assets. We are very flexible with our cash flow, so we will watch free cash flow, stay within free cash flow, and accelerate or decelerate plans as need be. And we will continue to pursue accretive acquisitions. We really believe that within the junior oil and gas space in Calgary, having accretive acquisitions, merging with other entities, lower G&A costs, increase development opportunities, increase capital efficiencies is really a key attribute going forward. So we just completed an acquisition. It was announced today, a merger with Marquee Energy. Spent a number of months putting this transaction together, but this is an example of how an accretive acquisition can help the company. Prior to the acquisition, we were just about 5,000 BOEs a day. We are now about 7,700 BOEs a day. So that should increase, one, our market awareness, which oil and gas companies sorely need, increases our scale, and so adjusts for SG&A and increases our ability to have additional accretive development opportunities going forward. Through this acquisition, our cash flow has increased, and we're now an organization that can grow about 18% per year on internal cash flow. That was based on the October strip, I'll be clear about that, but 18% year on an internal cash flow, or we could choose a model where you have partial growth, partial dividend. So we have free cash flow is really what the point I'd like to make. Through the merger, we did create a significant amount of synergies, $5 million a year of recurring synergies. This is a combination of savings in G&A, about $3 million. We only brought over 2 of the staff members from Marquee, and $2 million a year of operational synergies, which I'll show to you in a few minutes. So pro forma this acquisition, 3 core areas to develop in: Wayne, Machichi, Princess, and Evie. About 750,000 acres of undeveloped land, 115 proved locations to move forward with. And every time you drill a proved location, hopefully you develop additional proved locations. But there's the 5 years of development going forward. The real question for the investors is, why invest in an oil and gas company? There's a lot of disarray. I am going to show you the development model, but clearly on this slide, what I'm trying to show is the dislocation of the market and the value within an oil and gas company. So our share price, whether you want to look at PDP, total proved, or P plus P, on a debt adjusted basis, somewhere between 65 cents and $2.65. We currently trade, I think, about 28 cents. So there's a significant value disruption here that's going on. Synergies of the merger. I talked about the G&A synergies, $3 million a year occurring. On the operating side, in the yellow is some land that Prairie Provident owned pre-merger, and the salmon is the asset that we picked up through the merger. One of the challenges we had on the yellow land, which is called our Wayne asset, was we didn't own our facilities, so we were hauling our oil and shipping our gas to third-party processors. That's a cost to us, obviously. Through the acquisition of the merger with Marquis, they own their own facilities in the area, both gas and oil processing. So now we can link the two assets together, and by linking the two assets together, instead of paying fees to somebody else, we bring the production to ourselves. It's going to generate operating synergies of about $2 million a year. That helps us both in the Wayne area and in the Mechichi area, where we drop the operating costs on a per unit basis. So who are we going forward? We have basically two pontoons, if you will. Down south, Princess, Wayne, and Mechichi. Those are development assets where we develop via the drill bit. We drill those areas. Up in the EV area, it's primarily a waterflood asset. I'm going to show the attributes of that. There is some development drilling that goes forward, but we move between the two cycles depending on where we want to allocate our capital. And you can see the production predominated in the south, EV in the north. There's been a lot of discussion, I think, out here about the differentials that are paid for oil in Western Canada. We're fortunate in the sense that about 60% of our oil production is Western Canada light, so we get a better differential market than the Western Canada heavy, if you will. So we're not quite as bad as the $40 off diff, but it is still a challenging market. Board and management, I won't spend too much time on this, but all I would say is that the management team has, in general, myself 35 years experience, Tony Van Winkoop about 35 years experience, Joe Taylor 30 years experience, and then Brad Likuski and Mimi Lai about 15 years of experience. So well-experienced management team. So let's go to our development assets. So Princess in the south, if you've been following Prairie Provident, we released a few press releases this year about a number of wells we drilled in lithic lock channel. Those wells came on at about 1,000 barrels of oil a day. They're all doing north of about 500 BOEs of oil a day, so very strong economics. Those wells paid out in about 6 months, so we're really happy with those. Going forward into next year, we have planned another 4 wells that we may drill in the lithic lock channel, so we can definitely maintain or grow production with a very small amount of capital should we choose. In addition, in this area, in the green outline in the bottom part of that graph or that slide, that's an Ellerslie channel. If any of you follow Cardinal Energy, they have announced some drilling results in this Ellerslie play, so they're just offsetting us. Very strong results. That'd be a read-through to us. We haven't moved into that area right now. We might be moving into that area in late 19 or early 20. But very happy with the development opportunities we have down here. Operating netbacks around about $28 a barrel, so we're doing pretty good down there for moving our development plans forward. You can see the economics. Again, this is based on the August strip, but strong rate of return, less than a 1-year payout, strong recycle ratios. So very economic place for us to move forward. In the Wayne area, that's just offsetting the Mechichi asset. Wayne, we drilled 3 wells this year. Collective production right now is about 500 BOEs a day, just under that, 450. You can see the operating netbacks in Wayne, $15. That's an indication of the issues we're having with not having our own processing. Looking at the next slide, we can get the operating netbacks to $25 when we connect the 2 fields. That is just us paying ourselves versus paying a third party when we bring these wells online. Economics not quite as strong as the Princess area, but still, good pedestrian economics, very low risk drilling. We have potentially slotted 2 wells for next year, and we have about 6 or 7 wells to drill in that area before we fully delineate that area. In the Mechichi area, this is a new asset that we've picked up through the merger, about 2,700 BOEs a day. You can see fairly good operating netbacks, $22 a BOE. The predecessor company drilled 5 wells next year. We're going through how we would drill the asset in 19, and so we have generally selected about 7 wells to go forward. And when I say generally, we have not released a budget as yet. We're trying to get some clarity on where the differentials and the commodity prices are going to set down to understand our cash flow, but we've generally earmarked about 7 to 8 wells to be drilled. On this slide, you can see the impact of linking the 2 fields together. We increase our operating netbacks. In addition, on this slide, there's a lot of fixed costs in the Mechichi area, so this is the economics of an incremental well, and so very strong payouts, again, in the greater than 50% and 1.5-year 50% rate of return and a 1.5-year payout. So very strong economics. EV, this is the area that we discussed that is up in the northern part of the province. It's an area that we have basically a water flood. We just drilled 4 exploration wells up there through this last month. They're basically granite wash. 2 of those wells were successful and 1 is still under observation. We've just brought on an additional about 300 BOEs a day of oil from these granite wash wells, and we are moving to drill 2 Slave Point wells. But on the water flood, what we see in the water flood, we have about 5 or 6 sections under water flood right now. So water flood is a mechanism of injecting water into the ground to maintain or raise reservoir pressure so the wells produce at a more constant rate. You can see in these 2 graphs on the right side of this slide, primary producers decline at about 30% per year. The areas under water flood, you can see on the graph, no decline. And so we are quite enamored with this, the way we're moving forward with this water flood. We will continue to expand it out, but the intention is to take that 2,000 BOEs a day and move it to, instead of a 30% decline, to a very low decline, somewhere in the 10% per day range, where a minimal amount of drilling can maintain your production profile. So it's a longer term economic game. You might see rate of returns in the mid-30s, but what it adds is a lot of reserves. So if you're looking for an F&D number, very strong F&D numbers. So this is our inventory of development that we have going forward that we've discussed. Starting at the bottom, you can see all the recycle ratios are good. So every time you put a buck in, you're getting a good return coming back out. Operating netbacks in a very good range, strong F&Ds. What I like to look at is payout period. As a junior oil and gas companies, our challenge is to recycle cash as fast as possible. So payout periods sub $1 or in the dollar range are important to us. We've got a number of plays, well, 1 play below $1 a year, I should say, a couple plays within the 2-year range, so we can cycle cash fast enough. Rate of returns are all fairly strong, but the real message here is that we have a large inventory of development drilling, and so we can have competition of capital and move our development dollars around as we need to maintain either production or free cash flow or what we need to do going forward. This is our budget for 18, and we are inside of budget, so we'll meet all our targets. No changes to that. We have not released a budget as yet for 19, other than we are moving forward with about a 4-well drilling program. So we'll invest about $15 or so million. This is approved by our board, and that would essentially keep us flat. And so that's within our cash flows right now. We have actually underspends cash flow under the current forward strip by about $6 million. And then we will make a decision, a choiceful decision, once we understand commodity prices. Do we accelerate drilling, maintain the $6 million cushion and return it to debt, or what we choose to do? But we're just a bit cautious right now. Talked about hedging. This is our hedging profile going out over the next number of years. We tend to hedge about 65% of our total production in the current year, 45% in the 2-year cycle, and 25% in the 3-year cycle. The hedges are supporting us right now is in the downturn in the commodity cycle, so good to have them in place. And our hedging is generally quite mechanical. So it's important that you understand this. I know there's a number of investors that do not like a company to hedge. They want to play the commodity cycle on their own. We're a hedged company, so we'll always maintain our hedge basis. We want to protect our balance sheet, protect our play economics. So why invest in PPR? There's really 2 models here. One is the massive value disruption. So you buy the company today, if you believe the value of the reserves, the PDP value, you can double your production. If you're going to go to total proved production, you can almost triple your value. If the market ever comes back to a more normalized rate. The other side of the development cycle is that we have a company that has free cash flow, can grow in the current commodity cycle or just maintain its production base, whatever it chooses. We have a large inventory of opportunities so that we're not going to time out in 1 year. We have 5 years of development in front of us. And I think our strategy of doing accretive acquisitions, this is the 2nd accretive acquisition we've done as a public company. The 3rd, if you took our first acquisition that we went from private to public, and every one has been accretive despite the commodity prices. And so we've shown that we can do both accretive acquisitions and or development drilling. So we move down both avenues. So in closing, we have an attractive asset base. We're going to be about 7,700 BOEs a day, 70% liquids, strong value metrics in front of us, and I think it's an interesting story despite what's going on in the commodity cycle, and look forward to answering any questions.
This report brought to you by the Richmond Club, where investors and high-growth companies meet.